Hello everyone. Recently, the shares of infrastructure finance companies saw a fall of around 8 to 10% on the stock market. This fall, which happened on Monday, continued on Tuesday as well. Just to show you, the share of Power Finance Corporation fell from 480 to roughly 420. Similarly, if we look at the shares of REC, you can see that these shares also fell from a high of around 560 to somewhere around 507, 505. Now, what exactly was the reason for this? So, the key reason for this was a proposal by RBI, the Reserve Bank of India, for these sort of infrastructure finance companies. In today's video, I will discuss with you what that proposal is and what can be the implications of that proposal. And is this a fall which is to sustain, or is this something which is only a temporary fall in the long term prospect of the company? So, on that note, let's begin our discussion. I am CA Vaibhav Jain, and today I will be discussing with you the RBI proposal for higher infrastructure provisioning. As you can see, the article mentions that the Nifty PSU index, the Nifty PSU Bank index fell by 3.66%, and the Nifty PSE index, or the Public Sector Enterprises index, that fell by 2.79%, as well as the BSE infrastructure index that fell by 2.28%. And this all in all led to an erosion of around 1.83 lakh crores from the public sector stocks on Monday itself, and this fall continued on Tuesday as well. So what exactly is this provision or the proposal? So the proposal has two main components. The first part of the component is enhanced provisioning. So see, what happens now is, for any loan which is not a bad loan, which is not a substandard loan, which means for any standard loan, the provisioning norm is 0.4% currently. However, with this proposal, the RBI wants the infrastructure finance companies to increase that provisioning to 5%. So let's say if I am giving a loan of 100 crores to a infrastructure company, and as an infrastructure finance company wherein I was only creating a 0.4% provision initially, now the RBI wants me to create a 5% provision. The proposal further says that once a 5% provisioning has been done on these loans, this has to be done during the construction phase itself. So once a project is in the construction phase, any infrastructure finance company which is giving loan to that particular project has to do a provisioning of 5%. But when that project moves to an operational phase, the provisioning can be brought down to 2.5%. Furthermore, this provisioning can be brought down to 1% when it satisfies two conditions. The first condition is that the project should be able to generate cash flows enough to repay the obligations. And second, the long-term debt declines by minimum 20% from the commercial operations commencement, which means that the long-term debt which the project had incurred or taken has to decline by at least 20% compared to the long-term debt it had taken when the commercial operations were being commenced. So, if these two conditions are satisfied, the provisioning can be further brought down to 1%. Now, as any provision takes place, or as any such a transition takes place, this transition also will be taking place in three phases. To understand that, phase 1, which is going to be done in financial year 25, the RBI wants the infrastructure finance companies to create a provision of 2% and not directly 5%. In phase 2, by FY26, the RBI wants the infrastructure finance companies to increase the provisions to 3.5%. And lastly, in phase 3, by FY27, the RBI wants these provisions to go up to 5% as the regulation states. So one thing which is to understand is that the 5% provision is not a direct jump, which means that any of the infrastructure finance companies need not take all the hit at once. The hit will be taken in a transitionary manner if it translates into an act. What do I mean by that? As I'm using the word proposal, what you need to understand is that this is a proposal by the RBI which has been given to the Government of India. And the Government of India needs to deliberate and come back on this particular proposal by 15th June. And in this intervening time, obviously the banks and the finance companies or the NBFCs will be lobbying against the RBI's proposal so that they do not have to take such a hit on their financials. The second proposal is on the exposure limits. What do I mean by that? Ideally, what happens in a project finance is there is a group of lenders who lend to that particular project, and then these particular lenders are known as consortium. The RBI is saying that basis what is the total exposure, the RBI wants to define what can be the individual exposure. Let's take an example. Let's say that if a project finance exposure is worth 1000 crores, which falls in our scenario 1, which is up to 1500 crores. So if the exposure total is 1000 crores, the RBI is saying that the individual exposure should be minimum of 10%, which means in case of a 1000 crore total exposure, individual exposure needs to be 100 crores, which means that the RBI is saying that in such a case, maximum of 10 lenders can come into the consortium. Why can be this a particular proposal is because if this is not done, then there can be multiple lenders exceeding 10, exceeding 20 lenders, which can form a consortium. And in such a case, there can be no particular control or particular supervision from any of the lenders because each of the lender is individually small and does not have a significant skin in the game. And hence, to prevent that, the RBI might have brought this proposal wherein it is saying that each lender needs to have significant skin in the game and hence minimum 10% exposure needs to be there. Now, the slab 2 or the scenario 2 is for above 1500 crores total exposure. So, understand this from scenario 1, you derive that if the total exposure is 1500 crores, then the individual exposure will be minimum 10% or 150 crores. And if the exposure goes above 1500 crores, the RBI is saying that the individual exposure needs to be that 150 crore or 5% of the project exposure, whichever is higher. So, which means that in case the project is of a value of 3000 crores, in that case, the individual exposure will be 150 crores or 5% of 3000 crores, which is 150 crores, which means it is at par. And hence, you can divide it into three slabs. For projects up to 1500 crores, individual exposure is minimum 10%. For projects which fall in the range of 1500 crores up till 3000 crores, the minimum exposure is 150 crore per lender. And for projects which exceeds 3000 crores, the minimum exposure will be minimum 5% of the total exposure. And this in all is done to maintain the skin in the game of the lenders and enable the lenders to supervise the project in terms of the completion, in terms of the delays, and as well as in terms of the financial hygiene or the financial comfort of the project. Now, as I discussed with you both the proposals, proposal 1 on the increase or the enhancement of provisioning requirement and proposal 2 on the individual exposure limits, we need to understand what can be the impact of the proposal. And ideally, the two key stakeholders are the lenders or the project finance companies and the infrastructure companies. In our case, the shares which we referred to were REC and PFC, etc. These were the lenders or the project finance companies. And given that is the case, we can evaluate what can be the impact for both of these stakeholders. So let's understand what can be the impact on the lenders first. So from a lender point of view, we can think of it in this way that if the lender is asked to increase the provisioning to be done on the loans or the project finance, which means the lender needs to take a hit of that increase or the enhanced provision somewhere or the other. What can be the possible circumstances in this case? So first point here is how exactly will the lender take the hit in its financials for the increased provision? And second point is what will be the impact of that increased provisioning requirement? So first, in terms of the increased provisioning requirement, we can evaluate it in these two possible conditions or possible scenarios. First alternative can be that the lender routes the increased provisioning from its P&L, which means it will pass a simple entry P&L debit to provision. And which means that because the P&L is taking a hit, the PAT will take a hit, profit after tax, which means that the ROE, which is return on equity, will in turn take a hit, and hence ROE will be impacted. The second alternative is a portion through impairment reserve, wherein the project finance companies can use the existing impairment reserves and apportion some amount of it to provide for the enhanced provisions against these infrastructure finance loans or the project finance loans which they have given out. In this case, because they are using the existing reserves and not creating any impact on the P&L or the profit, which means there will be ideally no impact on the ROE. However, this is my understanding and I might be wrong here. In both of these cases, the capital adequacy ratio will be hit because the RBI wants to increase the risk weightage on these assets in a way. And because capital adequacy ratio is basically calculated as tier 1 capital plus tier 2 capital divided by the risk weighted assets, which means in my head at least, in both the cases, the CAR or the capital adequacy ratio might be impacted. However, what exactly will be the outcome of this provisioning and how exactly will it be taking place? That is something which we need to watch closely in the next couple of quarters. Now, what will happen because of this enhanced provisioning is that the banks or the finance companies will actually need to create a higher cushion for providing the same amount of loan. Let's imagine a scenario. If I'm a project finance company and I was giving out a 1000 crore loan, earlier I was just creating 0.4% provision. However, now the RBI wants me to create a 5% provision. Let's assume the ceiling, which means for myself as a finance company, I will be creating a 4.6% higher provision. And to provide that particular provision, I will be either taking a hit in my PNL or on my reserves, but somewhere or the other, I will be taking a hit. And as a business does, I will also try to pass on this hit to my end customer, which is the infrastructure company. And how will I do that? I will try to increase the interest cost which I charge to them. Now, if you think of a rough balance sheet of a project finance company, they will be lending out some loans to the infrastructure companies, which are known as the AUM or assets under management. They might have some other assets. Let's ignore it for a while. And to finance these or for a source of capital, they will have either their own funds or the equity or net worth or shareholders fund. And they will have some borrowings, which are liabilities or borrowings. Now understand the point. As per this proposal, the project finance companies are being asked to create additional provisions against their AUM, which means they will have to create additional provisions. And let's assume this is a net AUM, which means that the AUM will decrease on a net level. And as a balance sheet has to be balanced, the counter effect has to be given on the equity and liability side. Let's assume there can be two alternatives as we discussed. Alternative one was to take a hit in the PNL, whereby the net worth of the project finance company will decrease. Or alternative two can be to use up some of the existing reserves to create that provision. Now understand the point. In either case, to give out the same amount of loan, the RBI wants the project finance companies to have a higher net worth in a way or a higher source of capital, which means that for this particular source of capital or for this particular capital, there is some hidden cost. Ideally, if you look at it, there the cost of equity is sometimes not taken into consideration because it's not a direct cost or a upfront cost. But let's assume there is some sort of cost which the banks or the project finance companies will incur to give out the same amount of loan. And hence, the enhanced cost is something which will be passed on to the infrastructure project companies. Getting my point? Now, let's revisit our discussion from a lender point of view. So, from a lender point of view, what we can infer, and again, this is just an initial thought, is that for a project finance company, the capital requirement will increase, and hence the cost of capital in a way will increase for the project finance company, which it can either pass on to the infrastructure finance company or take a hit on its own P&L. Ideally, it will not take a hit on its own P&L, but if it does, then in turn, the profitability of the project finance companies will take a hit, and this can be one of the reasons why the market acted negatively on the this particular proposal on Monday. The second possible scenario is that the cost of this particular increased source of capital or increased capital requirement will be passed on to the infra companies. So now we need to think of it from an infra company point of view. Now, for an infra project company or an infrastructure company, their business model is what? They will take loan, they will create a project. Let's say it's a commercial complex, and then they will sell out those particular offices to the end customers, right? And then from whatever enhanced return they are getting, they will pay back the loan, and then that project is assumed complete in all sense from a sale of asset as well as repayment of obligations. But now understand that the life of these projects are 10 years, 15 years, and long term life. And hence, these infrastructure companies tend to take a lot of loan from the project finance companies. And those loans go as high as 85% of the project tenure. So now understand the point that given debt is a major source or a raw material for finance for these infrastructure companies, if the cost of raw material is increasing, these companies will again have a similar situation. They will either try to pass on the cost of that particular increased capital requirement or increased cost of capital to the end customers, which means the prices of the commercial complex or the whatever project it is will be spiked up. Or let's assume the project prices will not be spiked up, but the hit will be taken in the balance sheet or the P&L of the infrastructure companies itself, which means that this again raises a question on the viability or the sustainability of the infrastructure companies. This is at the outset of it. However, I think one key factor to consider here is the quantum of the impact. Now, in my head at least, let's say even if the RBI is asking the lenders to increase the provisioning, and even that is in a transitionary method from 0.4% to 2% to 3.5% and then to 5%. And that too is going on only in the construction phase. Once the project is completed, it goes down to 3%, and once the cash flow start rolling out, then it goes down to 1%, right? So now in my head at least, what is a very important factor in all this is what sort of quantum of impact will be created on the lenders. Let's assume that the lenders are not facing that significant impact on their balance sheet because of the enhanced provisioning. In that case, the lender might pass on a small chunk of that particular hit to the infrastructure companies, which in turn the infrastructure companies might be able to bear. And if they are able to bear it, in that case, this is not that big a issue. However, if they are not able to bear it, that is when the question arises on the viability or the sustainability of the infrastructure companies. Now, this in my head actually is an ironical situation also. Now, imagine this. The RBI is coming and saying to the lenders or the project finance companies that you need to create higher provisions for the project finance loans, right? Why is the RBI doing that? One possible question or one possible thought might be that because of the past experience in the infrastructure environment, wherein there have been lot of bad loans, possibly due to promoter faults, promoter frauds, and possibly due to other reasons as well. The RBI is wanting to create such a scenario wherein if such a situation comes again, the lenders have taken significant provisions in their balance sheets, right? However, now understand that because of the increased provisioning requirements, the lenders are passing on the increased cost in terms of the cost of capital to the infrastructure companies. Now, let's assume that the infrastructure companies are not able to bear that increased cost and it is taking a significant hit on their P&L, which means a question on their viability, which means again a question raises for the lenders themselves that because of their own action, is it raising such a situation wherein the asset, which means the infrastructure loan, has a tendency to go bad or become a non-performing loan? And that is again an ironical situation because the cause and the effect is both on the lender's hand and not on the infrastructure company's hand. The cause is the lender increasing the cost of capital, and the effect is the lender thinking that whether the asset will go bad or not in the long term because of this particular action. So that is another train of thought which I had when I read the proposal. So my closing thought on this is that while there are multiple speculations or permutation and combination on how this proposal will chalk out, there are two important things. One is that this is still a proposal. The government might come up with their own regulations or changes against this proposal. Point one. The banks and the NBFCs might be successful in lobbying against this proposal. Part of point one only. Point two is that let's assume this proposal actually becomes a notification or a guideline. In that case, also, We need to take couple of quarters to understand how exactly is the impact or the quantum of impact, as I said, chalking out in the couple of quarters which will follow post this regulation or post this proposal becoming a regulation. So that's my initial reading on the RBI proposal for infrastructure provisioning, enhanced infrastructure provisioning, and would love to know your thoughts in the comment section on this particular RBI proposal.